Imagine someone offered you two futures. In the first future, you retire with over $700,000 invested. You sleep better. You have options. You have freedom. In the second future, that money simply disappears. Gone. Not because of a stock market crash, not because of a recession, not because you made some reckless mistake, but because of a few monthly payments that felt completely normal. A car payment, a credit card payment, a student loan payment. Nothing unusual, nothing dramatic, just $1,000 here, a few $100s there, month after month, year after year. Until one day, you realize those payments didn't just cost you money. They cost you a completely different life. And that's exactly what's happening to millions of people right now. They think they're paying off debt, but they're actually paying a hidden tax, a tax that doesn't show up on any government form. A tax that quietly steals wealth, freedom, and decades of financial progress. Today, we're going to calculate that tax. We're going to meet two people earning similar incomes. One stays trapped, one escapes. And the difference between them isn't intelligence. It isn't luck. And it definitely isn't income. It's one decision. A decision that ends up being worth more than $716,000. But here's the strange part. The banks don't need you to miss payments. They don't need you to be irresponsible. In fact, their favorite customer is often the responsible one. The person who always pays on time. The person who never causes problems. The person who believes they're doing everything right. Because while you're focused on eliminating debt, almost nobody is calculating what that debt is preventing. And later in this video, I'm going to show you the exact moment one ordinary worker realized she wasn't paying interest anymore. She was forfeiting her future. And once you see the number, you won't look at debt the same way again. Meet Diana. She's 34 years old, works in HR, makes $67,000 a year. Not rich, not struggling, just normal. She meal preps, pays her bills, contributes a little to her retirement account, drives a reliable car, uses budgeting apps. From the outside, she looks financially responsible. And she is. But every month, Diana feels like she's running harder without getting anywhere. No matter how much she budgets, the finish line never seems to get closer. Sound familiar? That's because Diana has something I call a leaking bucket. Every month, money enters her life. And every month, money escapes. Some leaks are obvious. Rent, utilities, groceries. But one leak is different. Because it doesn't just remove money. It removes opportunity. Diana has $23,400 in credit card debt, $28,000 in student loans, a car payment. Total monthly debt obligations, $1,217. Now here's where most people stop thinking. They see $1,217 leaving their account, and they assume that's the cost. It isn't, not even close. Let's zoom in. Out of Diana's credit card payment, hundreds of dollars aren't reducing her balance much at all. They're interest. Money that disappears forever. Every month she pays it. Every month she receives nothing, no asset, no ownership, no future value, just a receipt. And that's where the real problem begins. Because money is supposed to have a job. Every dollar should either buy something useful or build future wealth. Interest does neither. It's simply a transfer. Your future funding someone else's future. And when we calculate what Diana's monthly payments could have become, the number becomes shocking. Imagine investing $217 every month. Not doing anything fancy, not trading stocks, not timing markets, just consistently investing year after year at historical market averages. 20 years later, that money could grow to roughly $716,000. Think about that. The issue isn't that Diana owes money. The issue is that a future version of Diana loses access to $750,000. And that's why debt is so dangerous. Because the bill you see is never the real bill. Most people imagine debt as a hole, but that's not what it feels like. It feels like a treadmill. You're moving, you're sweating, you're making payments, but somehow you stay in the same place, month after month, year after year. Then something unexpected happens. A medical expense, a broken transmission, a layoff, and suddenly the treadmill speeds up. This is where many people realize something terrifying. Debt doesn't just take money. It removes flexibility. It removes options. It removes breathing room. And almost nobody talks about that part. Now, inevitably, someone will say, wait a second. If my debt costs 5% and the stock market returns 10%, shouldn't I keep the debt and invest? Mathematically, sometimes realistically, that's where things get complicated. Because spreadsheets assume you're a robot. They assume perfect behavior, perfect discipline, perfect consistency. For 20 years, no panic, no emergencies, no emotional decisions, no mistakes. But humans aren't spreadsheets. Humans get scared. Humans lose jobs. Humans watch markets crash. Humans have families. And that's why behavior often matters more than theoretical returns. The best financial plan isn't the one that looks smartest on paper. It's the one you can actually follow. Now let's meet Daniel. Daniel earns roughly the same income as Diana, lives in the same city, faces the same economy. But 18 months ago, he made a decision. He declared war on the debt tax. Not his debt, the tax. Because he finally understood they weren't the same thing. He stopped asking, how much do I owe? And started asking, what is this debt costing my future? That question changed everything. Daniel listed every debt, highest interest rate first. Then he attacked the most expensive debt with everything he had. Every bonus, every tax refund, every extra dollar. At first, progress felt slow. Then something interesting happened. One account disappeared. Then another. Then another. And each time a debt vanished, its payment didn't disappear into lifestyle upgrades. It got redirected, stacked, added to the next target. The avalanche grew larger. And larger. And larger, until the momentum became unstoppable. 18 months later, the final debt disappeared. This is the moment most people never reach. The moment when the machine flips. Before, compound interest was working against Daniel. Now, it worked for him. Instead of paying lenders, he paid himself. Instead of funding interest, he funded investments. And suddenly his monthly cash flow transformed from a burden into a weapon. The same money, different destination, completely different outcome. Once debt was gone, Daniel followed a simple system. First, capture the full employer retirement match. That's free money. Never ignore free money. Second, maximize tax-advantaged accounts. Protect future growth. Protect future flexibility. Third, invest the surplus consistently. Not emotionally, not occasionally. Consistently, because wealth isn't usually built through giant financial decisions. It's built through thousands of small decisions repeated over time. But here's the part no spreadsheet can measure. The emotional cost. Diana has to think about payments before every major decision. Can I afford this? Can I risk this? What if something goes wrong? Daniel doesn't. His financial floor dropped. And when your floor drops, your ceiling rises. You can take calculated risks. Change careers. Start businesses. Negotiate harder. Think bigger. Because debt no longer owns your attention. The biggest lie about debt is that it's only about money. It isn't. Debt is about options. Debt is about freedom. Debt is about time. Every payment isn't just reducing a balance, it's deciding where your future goes. to you or to someone else. And that's why the real cost isn't the interest rate. It's the opportunity cost. It's the life that never gets built, the investments that never happen, the freedom that never arrives, the future that never exists. If you're carrying debt today, don't just look at the balance. Look at the number behind the number. Look at the future you're funding. Because once you see that number clearly, the debt stops feeling normal. And that's the moment everything starts to change. Comment below, future over interest, if this changed how you think about debt.